Neil, what do you make of what we just heard there from the Treasury Secretary saying Americans ready to retire aren't worried about the day-to-day market fluctuations?
Yeah, it's easy to say when you look at it in a hypothetical way. I think every time we get one of these bear markets or near bear markets, it hits differently, and it really does rattle confidence. Look, what's happened over the last few days is what looks like a stagflationary impulse, some inflation, some slower growth, is now looking like something worse than that, looking like an all-out recession. That's what we see in markets. That's what's happening with commodities, with the bond market. They're all pointing toward an out-and-out contraction in activity happening over the course of this year, and that's not where we were this time a week ago.
Yeah, and we're also hearing from Goldman Sachs and JP Morgan saying recession is more and more likely. Ron, you have the administration officials not only dismissing the stock plunge, but they're also brushing off the looming price hikes. Watch.
If cheap goods were the answer, if cheap goods were going to make Americans' real wages, real welfare better off, then real incomes would have gone up over that time. Instead, they went down because wages went down more than prices went down. So we got the cheap goods at the grocery store, but then we had fewer jobs.
Ron, is that a correct reading of America's wage gap? And will import taxes fix it?
Doubtful. And on the one hand, yes, we did lose manufacturing jobs, partly as a result of automation and not just trade-related policy. But we also saw consumer goods fall precipitously from the 1990s on forward. So people did have more purchasing power when it came to things like televisions, phones, new technologies. And so that disinflationary or deflationary impulse has been with us for quite a long time. There's a really arduous struggle here in the White House to explain in a coherent fashion what the end game is. On one hand, Howard Lutnick over the weekend, our Commerce Secretary, suggested that we're going to bring back jobs where people put screws into iPhones. That's not the type of
Ron, let me play that sound. We have that. Can we play it, guys?
The factories being built in America are huge.
That takes years, and you've said that robots are going to fill those jobs. So those aren't union
really automated
jobs.
It's automated factories, but the key is who's going to build the factories, who's going to operate the factories. The army of millions and millions of human beings screwing in little screws to make iPhones. That kind of thing is going to come to America.
Ron, continue your reaction to that.
Yeah, I mean, I don't think that's the manufacturing base that we're looking for. We're looking really, if we would like to stay competitive with the likes of China and any other major competitor, we want advanced manufacturing with higher skill, higher paying jobs. I mean, those jobs of screwing, tiny screws into iPhones, which are being done for $2 a day in other countries, are not exactly coming back to the United States, nor is T-shirt making, sneaker making, seamstresses, these businesses that went away because other countries could do that far more cheaply, actually benefited Americans, even as manufacturing jobs were lost. So there's a lot of twisted logic in explaining these policies. Are they going to raise revenue to offset the tax cuts? Are they going to be permanent, or are they temporary negotiating tools to get Europe, China, and others to bring their tariff rates and non-tariff barriers down to zero and stop impeding U.S. exports from going overseas? I'm struggling with the pretzel logic here that exists, and seems that the markets, while they're off their lows of the day at this point, are struggling too.
Joining us now, NBC News senior business correspondent Stephanie Ruhle, NBC News White House correspondent Yamiche Alcindor, and Henrietta Treyz, managing partner and director of economic policy research at Veda Partners. She worked with the U.S. Senate Finance, Banking, and Budget Committee and helped create policy solutions aimed at recovering from the 2008 recession. So, Stephanie, just this morning, since the open of the market, up a bit, up quite a bit, dropping down 1,600 plus points, now back essentially. What's going on?
Investors are desperately trying to figure out what is President Trump doing, right? There was a moment this morning when we thought maybe he was going to put a pause on the tariffs. He's meeting with Israeli Prime Minister Benjamin Netanyahu today. So the thought is, well, maybe if they come up with a more attractive deal for Israel, maybe that'll be the first of many. But at the end of the day, it's confusion, Jose, and the markets are up and the markets are down. They're trying to figure out, well, who's in the room with President Trump? Is it Scott Bessent, who isn't a super pro-tariff guy, or is it Peter Navarro, who's all about the tariffs? And that's the biggest problem. And it's the biggest problem for other countries who are our trading partners. It's the biggest problem for CEOs who run companies here and investors. They are looking to understand what's the trusted information? What's the long-term goal and plan from this administration? Even within the administration, you get conflicting messages. If we all watched the Sunday shows yesterday, you'd watch Peter Navarro believing these tariffs are going to be on for the long haul, and they're going to bring in trillions of dollars into this country. But if you listen to the likes of Howard Lutnick or Scott Bessent, they make it sound like where we are is just a starting point with the tariffs, and maybe they're going to go down. So if you're an investor looking to invest in the market, you need to know what's in store. And if you're a CEO and you're being told, trying to bring back manufacturing, are you really going to invest billions of dollars to build some plant here when it's going to be done in 3 to 5 years, when Donald Trump will not be in office? We don't know what the tariffs will look like or what any of the policies will be. And if you're another country, especially one that used to be our ally, if you're Canada, if you're Mexico, if you're anyone in the European Union, you're saying the United States, the democracy that I depended on as a partner and a trading superpower for all these years, can I still depend on them? Because last I checked, the United States has gotten more and more comfortable with executive orders, and it's not just unique to President Trump, also with President Biden, but Donald Trump is now ruling by executive order, not Congress. So how can you know what the policies are going to be? How can you have a trusted trading partner when things could change on a dime? And the answer is you can't, which is when you look at one thing, the dollar, it continues to weaken because people are losing trust in the United States of America.
And let's talk about that, Henrietta, the global reaction to what's going on. I mean, it's having effects on markets around the world. Trading was halted temporarily in Japan, in Taiwan, in South Korea today. How much damage has already been done?
I mean, I have to pile on here. $7 trillion worth of market cap just traded in 30 minutes. There is rampant chaos, so much so that Audi is actually just announced that they're not even going to unload the vehicles that are on their container ships to bring them into American soil because they don't know whether they need to charge American consumers 25% more on the cars today or if it'll be off tomorrow. And that's really the underlying problem here, is that the lack of cohesive strategy around the president's executive order trade agendas, as you just point out, are really what is creating this market inability to price in what will come from here. And what I'm trying to tell clients today and investors is that if you want Congress to send a message to try to exert any of its lingering trade authority here, you got T-minus 4 days. On Thursday, they're going to be gone for the Easter and Passover recesses, and they will be out of commission, out of D.C. for a month. And this is going to be exclusively Trump's domain to do what he will with these tariffs.
And so, Yamiche, does the White House see what we're hearing this morning, that there is a lack of cohesive strategy coming out of the executive on this?
Well, the White House is saying that.
Yep, the markets have once again opened with major losses this morning. There it is. Let's bring in CNBC senior markets correspondent Dom Chu. Dom, what are you watching here?
All right, so Mika, Joe, Jonathan, as we're watching another 1,300-point drop as we see things in the Dow developing right now, it's kind of important to put some of the context around it. In the 2 days since really the tariff announcements have come out and we've seen that 2-day market reaction for Thursday and Friday, data from S&P Dow Jones Indices now shows that 2-day drop in market value at just around nearly $6 trillion from the U.S. market wiped out. If you look at it from the record highs that we saw back on February 19th, that same data shows a nearly $11 trillion drop in the value of the stock market here in America since those record highs. Now, as you talk about what's happening today, we're seeing the follow through from what happened over the last couple of days, but a lot of it is due to this idea that there is still this notion people don't understand what the real effects of these tariff policies will be on not just the U.S. economy, but the global economy overall. That macro concern and that uncertainty is at least triggering some investors and some traders to rethink the assumptions behind what they think companies are actually worth. For that reason, you've seen a number of analysts and economists across Wall Street start to ratchet up their expectations for the odds of a recession. Of course, in a recessionary environment, when the economy is slowing down or actually shrinking in some cases, you have a scenario where the value of companies companies. The value of the economy goes down. If that is the case, then markets go down with them. The issue that right now that a lot of folks are dealing with is this kind of where does the administration blink, or where does the Fed maybe step in if it does so at all? Money markets, those financial instruments tied to, dollars and bonds and everything else, have now priced in what could be 5 interest rate cuts by the Federal Reserve by the end of this year. Now, the Federal Reserve has not indicated that they are imminently going to do anything with interest rate policy, but the data that comes in is going to help guide what their decisions are. I would point out, though, how quickly the narrative, the story around the economy, the American economic system has shifted from being one that's a little bit more fearful of inflation. And yes, tariffs are inflationary, certainly in the short term. But what does it mean for the long-term prospects for the global economy and the U.S. economy? Right now, 10-year U.S. government bonds are trading with a yield of 4%. That kind of a level doesn't imply that there's any real fear of long-term growth or inflation at all. And that's the reason why a lot of traders are a little bit concerned about whether or not we are going to be in one environment where the economy is slowing down. I'll also point out that where the rubber meets the road for a lot of these companies out here in America is indicated by how the technology sector performs. It is by far the biggest part of the American stock market. Those types of companies, and even some of the billionaires who are the founders and CEOs of them, have lost billions and, in many cases, hundreds of billions of dollars for a certain group of people over the course of the last few days. So
all the stock people are mad at Trump. All the Wall Street people. Trump's been there. He's tried to win those people over. People like Jamie Dimon, you've seen this, right? He was rumored to be Hillary Clinton's potential Treasury Secretary. This is a guy who potentially could have served under both administrations. And then he came out and he defended Trump's tariffs. It was a bit of a surprise. People weren't expecting that. This big CEO guy loves, markets and trade and all that. Said, well, the tariffs could have a could be good. There'll be some short-term pain, but maybe it's worth it. And guys, it's been like a week of tariffs, really 2 weeks of tariffs. And he's like, I'm out. This isn't working. Because here's the thing. There's a difference between targeted specific tariffs on a specific country for a specific industry. Now, I'm not saying I necessarily even agree with this tariff, but, Canada and the United States put a very hefty tariff on electric vehicles from China. Now, you might agree or disagree with that tariff, but that's one tariff on one industry from one country for a specific purpose of ensuring that you can build up your own electric car industry. It's not going to cause world chaos. Here's what Trump did. Tariffs on everybody, including Penguin Islands and whatnot. It's insane. But also, as some people have said, yesterday I had a clip, and other people have said this. Wall Street people have said this too. The people that are jeering Trump right now. Even if you do support the tariffs, even if you're from a part of the economy that will benefit medium and long term from the tariffs, you're not benefiting from these tariffs because they're too insane and they're not predictable. There's no rhyme, there's no reason, there's no strategy. If Trump was very clear with what he was going to do and then did it gradually and then stuck to it, then maybe it could have worked, for some people at least. But the way he's doing it, everyone loses.